Hello there, I'm Ariana CP Hunter, real estate broker and financial expert. And today we have a special guest, and he's going to tell us a little bit about himself and what he does and what he got to offer for all of us. So tell us a little bit about yourself.
Hello, my name is Shavarsh. I'm from LA, Los Angeles, California. I've been a mortgage broker for 17 years. And I work with over 100 different lenders right now, and we provide different types of loan programs, from first-time buyers to investors and construction loans.
Okay, and you're going to tell us about right now in this market, we want to know what's there available for the first-time buyer or for someone who needs to upgrade or must move and needs a mortgage. So can you talk to us about a little about what do you would recommend? What do you see?
Yes, absolutely. So for first-time buyers right now, I mean, it's a great market to be a first-time buyer because a lot of people have the opportunity to purchase right now. It's a great time to be in the market. For first-time buyers, we have 3% down programs. We also have no down payment programs. So depending on where you feel comfortable with the mortgage payment, you can go with that, but there are no down payment loans available, and and up to 3.5% down for first time buyers.
What is that? Oh, that's interesting. The no money down. How does that work? How does those work?
So there's different types of loan programs out there depending on where you're buying and which county you're buying in. So it all depends on that. But usually it's a grant. A lot of times it's a forgivable grant after a certain period. Or if it's not a forgivable grant, then it's a grant where it stays on your title, but you don't pay it until you refinance or sell the home. So there are no payments. But every county has different programs that come and go. So it all depends on where you're buying.
Now, as far as the time frame to apply for those, should they apply before they come and see you, or you send them that way in that direction? How does that work? How would they know about those programs?
So great. Yes. So basically what they do is they'll come to me, the client, the first time buyer, or it doesn't matter. It doesn't have to be first time. You can be a move up buyer or move down buyer, just depends. As long as it's your primary residence, you can, I'm sure there's a program that will be available to buy with a low down payment. Technically, the rule for a first time buyer is someone that hasn't owned a home for 3 years. So they'll come to me and then they'll tell me where they're looking to buy, which county, and I'll go ahead and see which programs are available for them, and I'll tell them about all the different options.
Okay, well, I know the answer, but I'm going to ask you because a lot of people don't. In where I'm located, the average home is about 240. Their loan will depend, of course, on their credit, right? And their income, right? And for somebody who's okay, just not too bad in the credit and not too good in the medium, what does 3% look like for them? I mean, we do this all the time. We know the numbers, but just so people have an idea, what would that entitle? How much do they see coming out of pocket at closing for that portion to getting the loan?
For how much? 200,000, you said?
Yes, the average home here is about 230.
230.
Number, for example.
So 230. So basically, for someone who's looking to purchase a $230,000 home with average credit, let's just say, the best product for them, the best program will probably be an FHA loan, right? So with 230, you're looking at about $8,050 for down payment, and then you're going to have closing costs. So closing costs can range anywhere from $10,000 to $15,000. So altogether, you're looking at maybe I'm going to give a high number, maybe $25,000 for out of pocket, with closing costs and down payment. However, in this market, there's a good chance that sellers can maybe pitch in some of the closing costs, credit. So it might be less than that, but you're looking at anywhere from $20,000 to $25,000 out of pocket to purchase a $230,000 home.
Well, don't be scared, everybody. That's just only in it's hard because everybody's independent individually and everybody's scores vary. So it depends on everybody's situation, right? Everybody.
Of course.
But just to give you, yes, 25,000, but there's negotiation. Like he said, it's a good time for the buyers because you have options in the housing available, and the sellers will work with you, give you an incentive, help you with those closing costs. So really, you will be worried more about your down payment, your appraisal. Basically, those are big in your credit pool, right? Makes it it's not that much. Can you tell us some of the expenses that are associated with getting a loan?
So you have you have the lender costs depending on which lender you go with. Usually there's a lender fee. That usually ranges in the thousands, you know, not very high. Every lender is going to have something different. Then you have the title and escrow fees. So those are probably the biggest part of the closing costs. And then you have the escrow account or the impound account. Usually when you're, let's say, for example, buying with an FHA loan, then you would have to pay the taxes and insurance with the loan payment, right? It's what we call an escrow or an impound account. So when you add all that in, that really becomes your closing costs when you're purchasing. So it's three parts. It's the lender fees, it's the title and escrow fees, which is the middle company, that everyone goes through, and then the title and the property tax and insurance portion, which is the impound and escrow account.
Yes. That's
So
because you're taking over somebody. It depends on the time of year you take over the property. That's what he's referring to. What you're going to be responsible for, and the person who owned the home before it will take care of the time they were in the home. So they prorate it, correct?
Yes, that portion, and also when let's say if you're buying with an FHA loan, 3.5% down, then you have to pay the taxes, the property taxes for the property, for the home, with the mortgage payment. It has to be combined. So what happens is the property taxes and insurance. So what happens is the lender collects upfront. So for example, you have 12 months in the year, the lender might collect 6 months out of the year for property tax, and let's say 6 months for the insurance, right? So combined, depending on the house price, it's all based on what the price is. They'll collect the 6 months upfront and put it into an account, an escrow account or an impound account, and that will stay with the loan for as long as you have the loan. But it's basically reserves in case you can't pay the mortgage payment or something like that. At least they have money in the account to go and take it out and pay your property taxes. So it's like a reserves account. So but when you're buying the house, you have to pay upfront, pay upfront with your closing costs, and put money into it's like a savings account.
Yes, to prevent. And that's actually how most of them are done. So don't be scared, because thousands of people own their homes, and that's the way they're structured, because the bank is looking ahead to make sure that you will have the funds to pay the taxes, and you will have the funds to pay the insurance in case something happens to your property. But you should not be scared, because he will take you step by step. It is what needs to be done all at once. It doesn't happen all at once. Correct? Like
Correct.
For the closing, yes, that date, but those expenses you could start collecting or saving for him, and go to see him. He will tell you where you're at. From there, you go see if you're ready or not, and he will guide you in the right direction as to what needs to happen in order for you, and how much you will need, so you could start planning for that moment.
Of course.
It's
yes,
a process, right? It's a process. Most people don't come ready to you. What is your experience in that? Most people, right? They need a little time.
Exactly. So usually, I mean, from the time I meet with a person, a first-time buyer, for example, by the time I meet with them and by the time they buy a home, it's usually anywhere from 6 to 12 months. So, if I meet with them right in the beginning of that idea of buying a home, it usually takes anywhere from 6 to 12 months. Sometimes it happens faster, but usually on average, it's a little bit longer process. So what we do is in the meantime, we look at their credits, we look at their finances, we talk about their finances, and basically create a plan so they can follow, so they are ready to purchase when time is right. And when they do purchase, they're comfortable with their purchase and their payment.
Yes, and that's what I encourage. I encourage you to talk to the lender first, because that way you buy the loan first, you have an idea, and then you don't fall in love with a property that you cannot afford, or maybe you're seeing properties that below what you're able to afford. So you don't have to live below your standards. You could live in a nice house and at a good price that you can live with. Okay, so usually lenders and the real estate agents work hand in hand, because we need to know right away. He will get, when you're ready, you'll get a letter, and you want to talk about the letter that you issue, so we're able to make offers.
Absolutely. So when it comes to the letter, there's two forms. There's two types, right? There's the pre-qualification letter, and then there is the pre-approval letter. Okay. So when you're starting the shop, it's always good to go with a pre-approval letter. The difference between the two is a pre-qualification letter is basically when you talk to a lender and you don't really provide your documents, you're kind of verbally talking to them. Maybe they pulled your credit, but that's about it. But you didn't provide your income documents, you didn't provide your bank statements, you didn't do any of that. It's all basically a verbal calculation and so forth. So that is not a very strong document for you and for the seller. If you were to make an offer with that, you always want to get a pre-approval. The difference with that is it's like almost getting the loan, but you're stopping at the point where you have to find the house. So pre-approval letter is basically you provide your documents, credit check, bank statements. We analyze the documents, make sure everything is accurate. We do all the numbers and the calculations. So it's almost like you're going through the process, but you're not. So that's that. With that letter, it's a very strong offer, because you and everyone else involved knows that you're going to get the loan.
It's like walking with a check ready to fill it out. Basically, that's how
exactly.
It is. You have purchasing power. They know you're serious. They know you're ready to go, that they have checked all your financials and you're good. Which brings me to the point why is it so important. You will get pretty much, you will check the credit twice, right? At the beginning and at the time they're closing. Because a lot of people, they decide to buy stuff for their house, and I don't blame them. We all get excited. But what happens? Can you tell us how many times? Is that correct? 2 times at the beginning and before closing that you check credit?
So if we start the process, let's say today, and you are ready to purchase, so you go out there and start looking at homes, and in 2 weeks you come back to me and say, I'm ready, I found the property, then I'm just going to pull your credit once. Okay. So because credits are good for 120 days.
Okay.
But usually at 90 day is where if you haven't found a property in 90 days, then most likely you're going to get your credit pulled again. So
that's good to know. That's good to know, because I always had the impression that they pull it at the beginning and pull it just before closing.
No, not me. Some lenders may do that, but I don't do it. I haven't done that in a while. That was when, like 15 years ago, when I used to work for the bank. I believe they did something like that.
Surprised by my question. You're like, well, we don't do that.
Yeah, we don't do that. So only if the credit expires. If the credit expires, then we're gonna pull it. But if you come to me, like I said, in 2 weeks, in a month, in 2 months, you come back and say you found a property, then we're just gonna go with the older credit report.
That's good to know.
We don't want to pull it too many times, because it hurts your credit, especially 2 months out.
But still, right? It's not a good idea to buy anything until they have. What are your thoughts on that? Purchasing, furniture or buying any major item before you're closing.
Absolutely, you definitely once you've decided to purchase a home, and your credit is good after you talk to a loan officer and everything looks good, you definitely don't want to make any major purchases, co-sign for anyone, and don't miss any payments, because yes, it can definitely affect your pre-approval, your approval. At the end of the day, it can throw off the numbers, because we look at how much money you make versus how much money you pay out to your debt. So there are ratios we look out for, and if you exceed those ratios, then that could mean trouble. That could mean that you won't be able to buy unless you change your price point or put more down. So but if you're looking with a minimum down, then you definitely don't want to do anything.
Well, thank you for letting us know. I know that, but it's important, but to make your job a little easier, and for everybody not to be surprised and say, oh, nobody told me, and you know, you guys supposed to tell me. I tell them that's very important not to touch. You buying the biggest purchase you're gonna have, and so you have to you cannot don't touch your credit, don't do anything major until it's time, until you close and you get your keys and when you fund it. Well, I'm gonna have to wrap it up. So I'm gonna put your information below the video so they can find you. I encourage everybody to visit him, you know, of course, by Zoom, by phone call. They could get a hold of you by email. And it's a process, it's a relationship. And basically he'll show you what he got, and you'll find something that works for you guys. You know, every situation is different. It's not one size fits all.
Of course, and there are different options, so don't be afraid. If you're thinking about buying, don't be afraid. Talk to a lender. You never know what's out there for you.
Well, thank you for your time, and we're gonna let you go. And anything else you want to tell our audience where we can find you? I know I see him on Instagram. Check him out on Instagram. He has YouTubes. He talks about he gives good tips all the time, and I wish we had more time, but it is a lot of information. But don't be discouraged if you hear all us talking about all this thing. When we talk to you one-on-one, we focus on you, and it's about you, and we only pull out the products that work for you. So you don't have to worry about all this information. You have to worry just making the right phone call in the right connection.
Exactly. Well, thank you for having me, Ariana. It's been a pleasure. You can find me on Instagram. It's probably the best place to find me. It's my first name _ last name. That's the best place to find me.
Okay, everybody. Thank you.
Thank you. Take care.